Vitalik Buterin is one of the biggest names in cryptocurrencies. His role as co-founder of the hugely successful Ethereum coin has gained him a large, almost cult-like following. He is as much of a techie as he is a deep thinker. His level-headed approach to rough waters has calmed many investors down when they needed it most. Recently, Vitalik uttered the cursed phrase, crypto winter, during an interview with Bloomberg. This might sound like a scary term, but not only is it normal, it could even mean an opportunity. We're going to take a look at exactly what Vitalik's theory surrounding the crypto winter is. He makes some great points. Stick around until the end of the video because we're going to explore what actions you should or shouldn't take as we head into what looks like a chilly crypto winter. Welcome back to Profit Protection. On our channel, we bring you news about ideas and information from the thought leaders in the financial world. We break down headlines about financial markets, cryptocurrencies, and digital assets from the people who understand them the best. Vitalik Buterin moved from Russia to Canada with his parents when he was only a young child. There, it quickly became apparent that he was gifted with mathematics and computer science. He first dipped his toes into the crypto world by writing for Bitcoin magazine, the first serious crypto-based publication. While still getting his higher-level education, he released a white paper detailing his idea surrounding a new coin, Ethereum. Vitalik was lucky enough to receive a grant to pursue the cryptocurrency's development. Eventually, he co-founded Ethereum at only 19 years old. Since then, he's been hailed by the community as the literal philosophical leader of the Ethereum user base. In the past, Vitalik has mentioned that he does not wish for the community to depend on him as a thought leader. Rather, he prefers to focus on the research and development of Ethereum and other crypto efforts. In a recent interview with Bloomberg, Vitalik spent plenty of time talking about the benefits of Ethereum, as well as the future of both it and Bitcoin. His deep knowledge of blockchain technology and financial systems validates his thoughts many times over. In response to the sliding price of Ethereum and other cryptocurrencies, he had a very level-headed and unfazed reaction. The people who are deep into crypto, and especially building things, a lot of them welcome a bear market. They welcome the bear market because when there are these long periods of prices moving up by huge amounts like it does obviously make a lot of people happy, but it does also tend to invite a lot of very short-term speculative attention. He makes a great point. While skyrocketing prices are exciting for everyone involved, rarely is it sustainable. Those hunting for short-term gains are glad to hop in and hop out as prices bounce up and down. The volatility makes headlines, and the headlines perk up investors' ears. Thinking about those long-term holders and the developers behind blockchain tools, it seems unsurprising that they aren't always wishing for big jumps. Rather, a calm and collected crypto community gives them the time and space to help further advance technology. On this particular subject, he said, "Winter is the time when most of these applications go out. As a result, you can see which projects are long-term sustainable, as in their models and their teams and their people." This rings true on many levels. For one, the truly determined teams with goals far in the future are not fazed by the cyclical nature of crypto. They understand the system and have faith that eventually the price will rise again. Secondly, crypto winters drive away the get-rich-quick gurus who use hype as a marketing tool. Instead of relying on fundamental principles to promote their crypto schemes, they simply point to how quickly the price is rising. When money is being made, they'll crop up everywhere online. When the scene gets cold, they are quickly weeded out. How will we know if we're in crypto winter? What have past crypto winters looked like? Those who don't learn from the past are doomed to repeat it. Learning from history can be one of our greatest tools when making important decisions. This is even more evident in finance. Let's take a look back at some of the past crypto winters. Let's take it back to 2011, the first long bear market that Bitcoin fans witnessed. The digital currency's value had spiked in the summer of 2011 to a high of $31, but within months it had fallen to a low of $2 per Bitcoin, a 93% drop. That wasn't all either. Thanks to the exchange hacks and regulatory issues in 2012, Bitcoin's price dipped into a crypto winter for roughly 185 days, losing 40%. Near the end of the year, things began to lighten up. The end of 2013 saw Bitcoin's value jump considerably again touching a peak price of $1,166. Unfortunately, the excitement ended in December 2013, and the onset of the first extremely long crypto winter began to rear its head. The bear market stretched for 410 days, encompassing 2014 entirely. After the $1,166 high, Bitcoin lost a lot of ground, falling to a low of $197 per coin during the first week of 2015. The momentum then began to build again, but only for a few years. In 2017, things were looking great. Crypto was quickly growing in market cap and price. After the price surpassed the 2013 all-time high, Bitcoin and many other cryptocurrencies grew substantially. The new all-time high turned into an impressive $19,650, but was short-lived. The bear market that followed lasted much longer than the 2013 to 2015 downtrend to 410 days. The crypto winter following 2017 was the longest ever, until 2020 rolled around and the market regained life. As we see here, there appears to be a long cycle of growth and hibernation that the crypto market rides. It happens before, so it would not be a surprise if it happened again. Now, we're beginning to see signs of a major slowdown. Could this be the start of a new crypto winter, like Vitalik Buterin claims? If so, what's driving this crypto winter? What's holding the market back and scaring investors? This is not a simple question, and neither is the answer. In fact, there's not one main reason for what seems to be our next crypto winter. Here are a few things that may be affecting the market that mirror past crypto winters. Number 1. Uncertainty over inflation fears is making investors reconsider where it's best to hedge their wealth. Previously, it seemed as though inflation was possibly becoming uncontrollable. Now, with the Fed looking to raise interest rates yet again and regain control, crypto buyers are hesitant to make a move. Number 2. Cryptocurrency has now grown and is being recognized as a concept globally. It may not be integrated into every nation, but governments are beginning to take it seriously. That being said, there is no telling how they would truly react. Regulation fears are valid. If you want to find out more about the possibilities of government interference with cryptocurrencies, we highly recommend that you check out our past video, Ray Dalio Believes Crypto May Be Outlawed. Number 3. This downturn in crypto prices also mirrors the general attitude toward riskier assets in the market across the board. The government is pulling out all the stops to keep the economy from going into free fall, and fears in the financial market nearly always bleed over into digital assets like crypto. Number 4. War. This probably doesn't surprise you, but the threat of a large-scale war causes many investors to shrink back from risky bets. In Europe, Russian invasion of Ukraine is simply too close to home for comfort. Even in the United States, the instability across the pond is leaving many people shook. So, if we have all these forces weighing down on the crypto market, the near future doesn't look super bright for crypto holders. There's no telling when or if positive influences will return to the board. If that's the case, how do you navigate a crypto winter? Number 1. Dollar cost averaging. Dollar cost averaging, otherwise known as DCA, is a strategy used to accumulate crypto without stressing over the current price. At its most basic, dollar cost averaging means to purchase coins at regular intervals regardless of price. This ensures that you get an even spread across time. During a crypto winter, this can be particularly useful. No one knows when the market will rise again, so buying regularly not only ensures that you don't miss it, also that you have crypto in your wallet when it pops off once again. Number 2. Don't use leveraging. To put it simply, leveraging refers to borrowing cash to make a trade. In theory, this can mean that you make more money than you could have with your own cash. Now, to put it simply once again, leveraging is asking for financial ruin. You should only utilize leveraging if you have deep knowledge of the market and deep pockets. Even then, it's a move so risky that even experienced traders are wary. In the case of crypto winter, it may be tempting to put more money in and buy the dip. While this may be a good strategy, using leverage is not. You are literally betting more than you can lose. Number 3. Reduce your exposure to less stable altcoins. While it is true that most altcoins follow the price of Bitcoin in the crypto market as a whole, they become even more unstable in a bear market. If we are going to see an extended crypto winter, many small coins that were growing based on hype will drop quicker than those built on real fundamentals. If you're going to dig in and hold for the long term, your best bet may be more dependable coins such as Bitcoin and Ethereum. Number 4. Do your research. Like any trade you ever make, buying and selling crypto during a bear market should be done only after extensive research. Use this time of lower volatility to calm your nerves and focus on the fundamentals. Regardless of how you approach crypto winter, remember why you want to buy crypto in the first place. For example, if you are buying Bitcoin or Ethereum with the intention of holding long-term, such as 5 or more years, then you don't have much you need to do. Your job as an intelligent investor is to hold tight to your strategy. If you are buying into crypto as a way to get rich quickly, this might not be a great time for you. If you are trying to get in early on crypto and profit off the eventual growth, you'll just have to sit tight a little longer. In the meantime, just like Vitalik said, crypto projects will grow stronger and serious investors will become more dedicated. Enjoy the cold weather. Cryptocurrency is changing the way we understand money and value. It is helping the regular layperson to take back control of what they do with their finances. We truly appreciate your views here at Profit Protection. We are bringing you valuable information and ideas from the thought leaders across finance, cryptocurrency, and digital asset spaces. If you enjoy the channel and have learned anything from it, please offer your support by liking and subscribing. It helps us to continue bringing you high-quality content that both educates and entertains. Once again, thank you for tuning in. See you next time.